most people are not aware of the importance of the credit market cycle, but it is really, really influential. And it starts really with the fact that most people don't think about enough, which is that nobody pays their debts. Governments never pay off their debts. You think that the UK government will ever in the future have a day when it owes less money than it owes today? I know the US government will not. Most companies never reduce their debt, and most individuals don't reduce their debt. They just put it on the credit card and then they pay the minimum payment to get through, but they owe more money every month. Nobody pays their debts. They rely on the ability to roll their debts over. So the U.S. government issues some 5-year notes. The 5 years pass. They assume that when they mature, they'll be able to go back to the credit window and say, "I'd like to borrow that money for another 5 years," and the credit person behind the credit window will say that's fine. And that's the way it usually goes. But what happens if a company has some bonds, the bonds are outstanding, the bonds mature, they go to the credit window, they say, "We'd like to borrow that money, roll it over for 10 years, and the credit window's closed that day? What if it's a day of panic? What if it's a day when people are so terrified of risk that they will not renew the debts? Then that debtor is bankrupt. So the availability of credit, the openness of the credit window determines life or death for borrowers. And its openness is dependent on the mindset of providers of capital with regard to risk on that day. And it's extremely important. And one of our outstanding businesses at Oaktree is called distressed debt investing. And basically there have been 3 times we started that in '88, so we're now in our 31st year. There have been 3 times that we had exceptional opportunities to buy distressed debt at very low prices because other people were panic and refusing credit. 90-91, the first crisis in high yield bonds. 01-02, when we had the telecoms meltdown that had overborrowed to build fiber, and the scandal companies of Enron and so forth, and then 08, the global financial crisis. Yeah. I wrote a memo in September called The 7 Worst Words in the World. Yeah. And what are the 7 worst words in the world for an investor? Too much money chasing too few deals. When there's too much money chasing too few deals, the prices get bid up so that the prospective returns are low and the risk is high, and you want to know that. And again, that's a function of attitudes towards risk, availability of capital.
So you describe cycles as being chain reactions, that the length or the amplitude of the cycle is a function of what's happened before.
Right.
What do you think the seeds are that are being sown now in this current cycle that will have an impact in the future?
Well, I'm much better at predicting the past than the future. But let's talk about, and one of the things I say, I don't believe in forecasts, and like Galbraith said, and one of the things that I say is we never know where we're going, but we sure as hell ought to know where we are. So where are we? We're in the second half of the 10th year of an economic recovery. And there's never been a recovery in the United States that went more than 10 years. So based on the data, we're coming to the end. Now, the process doesn't work like clockwork. The fact that there's never been a recovery of more than 10 years doesn't mean there never will be. And there's every chance that this will go on beyond 10 years.
It's been a long recovery, but a slow one.
Well, and that's the other thing. It has been the slowest recovery since World War II. So why is that important? And the answer is, well, I was writing this book called Mastering the Market Cycles, and indispensable resource. You know, I believe in cycles. I think cycles are one of the most important things for us to study. And I believe that they have, you know, I've lived through about a half a dozen really important cycles in my career. And they have given me a lot of opportunity to make money. They've given other people a lot of opportunity to lose money. So I believe there always have been. I believe there always will be. I believe they're very important. And I believe that they are understandable cycles. But as I got about 2/3 of the way through the book, I said, I had a revelation. I said, why are there cycles? U.S. economy grows on average about 2% a year right now. Why doesn't it always grow 2%? Why sometimes 3 and sometimes 1, sometimes 4 and sometimes negative, sometimes recession? Why not just 2 every year? Stock market, your S&P return, you mentioned earlier, returns about 10% on average. But not only does it not return 10 every year, but it rarely returns between 8 and 12. So the norm is the average is not the norm.
Yeah.
Why? Why do we have mostly above average years and below average years rather than average years all the time? And the answer, in my opinion, is excesses and corrections. So people get excited, they commit errors of emotion, and so if something has a U.S. economy has a 2% underlying trend line, they get excited, they make decisions to invest and to purchase and to produce and to hire, which causes it to grow more than 2 for a little while, but then it turns out that everybody made decisions that were too positive, and that has to be corrected, and so they stop investing and they stop producing and they stop hiring, and then you have a below average year, excess and correction. So I think that when you think about cycles, rather than think about ups and downs, I think it's much more helpful to think about excesses and corrections.